Sukumar the MD and Chief Investment Officer of Franklin Asia Equities at Franklin Templeton Investments joins us now. Sukumar, hi, good morning and thank you for joining us. It's been an extremely topsy-turvy ride for the Indian equity markets this year, and give and take everything, we've lost about 10% of our value since the start. What do you expect in 2016?
So I expect that the market would consolidate and show probably some upside over a period of time. I think the biggest challenge has been the earnings growth for the Indian companies has been below expectations, partly because of global factors and partly because of domestic factors. But over a period of time, we expect better traction and the better earnings growth and should probably improve the optimism and make people, invest more in Indian equities.
Okay, well, Sukumar, good morning. More importantly, we've invited you also because of the big Fed event that's just gone by, the first hike in a decade. As an Indian investor, how should you look at the Fed and the global events? Will they be helpful? Will they cast shadows? Will they pull out funds? For the next 12 months, what's the reading?
The Fed has always been saying that they will be data-driven, and so they have started an increase because they see that the employment has reached high levels, and the inflation should move towards their target of about 2%. So they are quite optimistic about pickup in growth and the employment levels being at high levels. And if that continues to be the situation, then I think there should be a gradual increase. I don't think that itself should be a major negative or positive for the markets. I think the market is going to be more influenced by a lot of other events other than the Fed increase. I think what happens in emerging markets like China are going to have a bigger impact. I think the extent and quality of growth in emerging markets is something that is not well understood, and more clarity coming on that will probably have an influence on the market movements.
But what about some of the key positive triggers that were lined up for this year? For example, GST. Now it seems to be off the table. The Congress has, blocked the passage of the GST completely. Would that be a big disappointment for an Indian investor?
For long-term investors, it should not be, because GST is something that will deliver better growth and tax compliance for a period of time, not necessarily on a one-year time frame. And also some delay shouldn't have a big impact on the fundamental value of stocks. However, I think people who are more sentiment prone, I think there could be some sort of a negative reaction, and I think that's probably already happened.
Okay, Sukumar, when are you expecting the earnings growth, or what are you expecting the earnings growth to be in FY17?
Looking at 1 year earnings growth is not relevant in my view. So we have to look at what is going to be the sustained earnings growth over a period of time. So our model suggests that the earnings growth over a cycle is going to be probably 1.2 to 1.3 times the nominal GDP growth. So if you assume about 8% real GDP growth and about 4% inflation, we are looking at 12% nominal GDP growth, and about 15% earnings growth is the real potential. So at some parts of the cycle, I think the growth is going to be below the cycle average, and at some points it's going to be above the cycle average. Right now it's below the cycle average, and as the margins expand, I think it'll be above the cycle average. So, that's what we are looking forward to over the next 5 years.
Okay, actually, then I should have asked the question that I initially had in mind. At what point do you see the cycle turning? As you say, we are now running below average, below that 15% earnings, which an 8% real growth suggests. Does it get to that in FY17, 18? How much longer?
So in my view, we are in the beginning stages of a cyclical upturn in the economy. So basically, I think in 2016, I think the consumption growth, in my view, would be much better than 2015. And the investment growth is also showing signs of pickup, though I don't think in 2016 it's going to be a very high number in absolute terms. I would expect an improvement compared to 2015. So with both the investment and the consumption growth accelerating, I think there is a case for some amount of margin expansion in 2016.
Okay. In your assessment, has domestic investor sentiment or domestic investor confidence reduced or waned in any way? Because, the money that we've gotten this year is largely from the domestic front. Will that continue next year?
I would think that over the next few years, I think there'll be more money coming from domestic investors. Because I think still equities continue to be one of the more attractive asset classes to really invest from a long-term point of view and create wealth. So I think as people realize, with the improving investor education and better distribution of equity products, I think the equity allocation will continue to increase. In any case, it's at abysmal levels now.
Okay. Yeah, one hopes, given the real interest rates. But Sukumar, you're speaking about consumption growth as your choice. How would you play it? Staple stocks are already pretty expensive.
As an investor, one has to be bottom up. One has to really, value companies based on the long-term value that they are going to create. What I was mentioning is about, what are the factors that is going to lead to acceleration in economic growth. Whether one has to invest in a particular consumer staple stock is a different issue, and I think bottom-up analysis is what is going to help investors decide on which stocks they have to invest in.
Would financials be a substantial part of or should financials be a substantial part of a fund manager's portfolio? Is all the bad news out? Would you worry about the technological disruption from payment banks?
Well, we believe that well-run banks are not going to go out of fashion anytime soon. The payment banks might have some place. But I think in terms of the ability to grow the business for good quality private sector banks, I think there are still going to be a lot of tailwinds in the next 10 years. Even today, after being in the country for about 20 years, the new generation private sector banks still have less than a third of the total market share. I think there's a potential for that to go to might be 60 or 70% over the next 15 years. So there's going to be a market share gain. On top of it, we also expect that the banking system itself will be growing in double digits because the banking system grows faster compared to nominal GDP because the financial savings is going to increase as a percentage of total savings. So I think I still expect a lot of tailwinds. I think the competition is going to increase. So to that extent, I think the banks cannot take things for granted. But I think the management which build the moats for a period of time have built moats over the last 10 years and are building moats in the future as well, should probably see the margins protected and the business grow.
All right. Sukumar, it's always a pleasure listening to you. Thank you very much for joining us and, well, giving that long-term confidence to the Indian investor that the 15% is the mean average, is the mean that Indian earnings will revert to. Thank you very much for joining us. Have a great 2016. Well, let's take one look at the markets yet again. Sobered a goodish bit, you will have to say.